Hello, and welcome to our program, The Path to Prosperity, Financial Literacy for the 21st Century. This groundbreaking library of knowledge is brought to you by the Steve Beeman Group and will help you and your families navigate the waters of your financial future. Politicians promise everything under the sun. Motivational speakers excite our emotions. But the Steve Beeman Group has put together valuable information in this library to provide real help for real people. This isn't a political promise of getting something for nothing, or a rah-rah speech designed to make you believe you can be rich. But rather, we provide you with an intensive study of finance and economics from a practitioner who knows what you need to know to be successful. The Steve Beeman Group has worked very hard to make this program enjoyable as well as informative, using language that you'll understand, not the fancy words of Wall Street that can leave some of us bewildered. We don't teach you academic ivory tower theories of how things should work, but the real-world realities of how things actually work. Steve Beeman has devoted almost 30 years of his life to practicing economics and finance, and has extensive experience working with retail consumers all the way up to institutional investors. His practical experience spans the breadth of Wall Street, and he is now available to help you take control of your own destiny. He will help you chart a course unique and accountable to you and your family. Now, finally, you will be truly empowered to create financial plans that work. You will no longer be forced to listen to the, quote, financial professionals, unquote, who seem to speak a language of their own. Steve will teach you how to see through the facade and behind the wizard's curtain to see how things really work. You will learn practical lessons like how to save money on banking and not pay for image, how to manage your debt smartly, and how to manage your FICO score, that's your credit score, so that you can get the best possible interest rates. You'll learn how to build a financial plan that works for you, how to invest your money, and especially how to avoid taking the advice of charlatans who are out to exploit people's lack of knowledge. You will become the master of your own universe. No longer will you be a slave to the Wall Street masters. This practical information library is divided into 2 volumes and 12 CDs. The first section covers basic introductory information you absolutely must know, and the second section moves into more intermediate information. In the first section, Volume 1, entitled The Basics of Financial Literacy, covers banking and credit, savings accounts, and basic insurance, knowledge everyone from the high school student to the most senior among us needs to know. This continues into income management, how to generate savings, manage taxes, and accrue income in an increasingly competitive world. The second volume, entitled Intermediate Financial Literacy, begins with financial planning and integrates key economic material to help you understand what you need to know. It also covers and moves through the world of investing from the most basic concepts of stocks, bonds, and mutual funds to more complex issues of options investing. Finally, it will explain advanced concepts ranging from tax shelters to advanced investment strategies. We have also produced a workbook to help you integrate this powerful knowledge into your daily life. In addition to this powerful audio library, we've established a website at stevebeemangroup.com, where you can ask questions directly to Steve Beeman about the material. You can also go there to hear the vast wealth of information contained in the hundreds of SBG audiocasts and see other ebooks and other tools provided by the Steve Beeman Group. If all this sounds good, it gets better. The Steve Beeman Group not only helps you grow and understand the financial part of your life, but was created to also help you on all the paths of your life. Would you like to improve your attitude and prioritize your emotions while developing the attitudes of successful people? Do you want to begin a new physical path to improve your health and wellness? Are you open to expanding your intellectual horizons to become a more well-rounded and smarter person? Are you interested in exploring purpose in your life's meanings? Well, if you're interested, the Steve Beeman Group will walk with you as you journey on your spiritual path as well. In short, the Steve Beeman Group has built a resource for you that will provide you guidance on your journey of life. This financial library is critical and fundamental to your well-being, but without the same knowledge on all of the paths of your life, you may not find yourself living up to your full potential. And that's what we're all about, helping you live up to your potential. The Steve Beeman Group believes in the individual and believes in your ability to improve your situation. Steve believes that the only way to promote happiness, prosperity, liberty, and goodness is through real help for real people. So join us today on your path to prosperity.
Hi, I'm Steve Beeman, and thanks for joining me on this expanded financial literacy program, Your Path to Prosperity. You know, I've spent most of my life working with people trying to improve their investment performance, and through that experience, it's become very clear to me that regular people just like you simply aren't given the information that you need to create your wealth, to manage your wealth, and thereby create a financial situation for yourselves that meets your needs. I mean, the statistics are just overwhelming. Over 90% of Americans retire without the money they need to live as they want. There's a home foreclosure every 90 seconds in this country, and I could go on and on. Well, that was the genesis of this program for me. I felt compelled to create a program that would empower people with the knowledge they need to survive and to thrive in this new century with all of the challenges that do exist. You read the papers like I do. We have a situation today that boggles the mind. Unemployment now runs around 10%, and you know, for young people, it's more like 25%. In fact, in the young African American community, it's approaching 50%. We hear daily of the debt bomb that hangs over our head with federal government debt at $13 trillion, or is it $113 trillion when everything's counted? We see advertisements all over the place telling us to buy gold because the currency is going to collapse. But then we hear economists telling us that we face deflation, not inflation. And frankly, why does it matter anyway? We have a hard enough time paying the bills without even thinking of putting away more money. Medical costs are rising, college costs are rising, and we're beginning to look at retirement as a historical concept because our investments just haven't lived up to what we need, period. So what do we do? Who do we listen to? Well, all of these questions came together and made me just think to myself, enough. There's got to be a better way, and I am firmly convinced that there is. If you study wealthy people and live among them as I have, and then you look at those mired in poverty, you begin to realize that the differences aren't all that great, but they are substantial. The key issue, I believe, that keeps some people bound to the servitude of poverty, yet propels others to the heights of wealth and prosperity, is simply knowledge. And it's not necessarily the knowledge gained through an academic master's program, but the basic foundational knowledge that seems so simple to some, but so foreign to others. Well, as I began this Path to Prosperity program, let me give you a little background because quite honestly, I'm just like you. It's just that I've spent years learning what I believe should be commonly known. I grew up in Indiana, the fourth child of a typical Midwestern couple. After high school, I went down to Purdue University and I studied political science and history. I don't know why. I guess I toyed with law school at one point. But more than that, I just found it interesting. Well, anyway, during my time at Purdue, I also started my first company, selling cookware door to door. At our peak, this little company had 45 salespeople bringing out our products direct to the consumer. The life lessons learned from this were innumerable and ranged from the basics of entrepreneurship, how to start a company, how to keep the books, how to file taxes, and even how to do payroll, but more importantly, the bigger lessons of how to motivate people, how to bring out the best in people. As college wound down for me, and so did this company, I read an abstract article about the Apple IIe. Now, many of you may remember that. Well, that awareness led me to write my first booklet, Computers Made Simple, and I then began a consulting and speaking company. During this time, I also became involved in the stock market, penny stocks to be specific. I learned of a small company that was going public, and that made my naive optimism go wild. This company, a small technology company, had the promise of becoming huge, like so many you read about. And it came out public at 10 cents a share and quickly ran up to 33 cents. Well, to make a long story short, I figured out how to buy a whole bunch of that stock at 33 cents. And then I went to Mexico thinking to myself, how hard was this? Why do people fret about money all the time? This little stock will go up to $3 and I'll be retired at the ripe old age of 23. Well, as you can probably guess, it didn't go up. It went down to 3 cents, and that proved to be the beginning of my financial career. As a result of that disaster, I went to work for the E.F. Hutton Company. For a young, ambitious person like I was, this was great. I went through their 6-month training program and was awarded the title of Registered Representative, which translated to the world at large as financial expert. Well, the reality was I knew very little, but I did know more than the average person. And what I found out is that average person could be the retired business executive, the professional attorney or architect, or the widow down the street. It struck me that most people knew nothing about Wall Street, nothing about its products, its language, or anything else. I remember so clearly working with people, many of whom were elderly, retired, and often widows. They would take meetings in the evenings because, quite frankly, they were bored. There were certain experiences that really stuck out in my memory. One, an elderly widow accepted an appointment, and when I visited, she asked me what I thought of some stock she had just bought, Herbalife. I asked her why she bought it, and you know what? I can almost still hear that sweet lady's voice in my head. She said to me, "Oh, the young salesman was so nice, and he said it would go up." Ladies and gentlemen, I almost got sick. How could anyone sell a stock, especially a stock with venture capital qualities, to this poor woman who lived on meager investments, especially at a time when interest rates were at 15% and she could have secured a 15% income on that money? Well, another memory that stands out was of a young couple who had just retired. They had managed to save around $1 million, which, if you go back with me to the early 1980s, was substantial. They just wanted income and security from this money, so I sold them a series of bank certificates of deposit. These CDs yielded around 15% and cost them very little in the way of commissions. Well, if my first lesson was that people bought from nice young salesmen, my second lesson was Wall Street interests don't always align with their customers. My management wasn't exactly thrilled that I sold those CDs. They'd have rather, frankly, that I sold a government securities mutual fund. Why? Well, it's simple. The mutual fund had big upfront loads or sales charges that would have been paid to the firm and to me. So I learned that the interest of Wall Street don't always align with the interest of Main Street. But I had also learned from my study of history that the solution to this wasn't simply government intervention, but it was empowered individuals who had the knowledge to deal securely with the world of investing. I moved from the retail world at E.F. Hutton to the institutional world with Zacks Investment Research, a Chicago-based provider of investment data, software, and stock selection models. This continued my learning experience and exposed me for the first time to institutional investment managers and the complexities of portfolio management, stock selection, asset allocation, and all the rest. I was also exposed for the first time to true academics. And I'll tell you, folks, academics do see the world differently than you or I. Well, anyway, subsequent to Zacks, I went to Wharton Econometrics, where I sold econometric data and consulting to the Fortune 500 companies. This continued my learning curve for economics and also continued to build on my understanding of how academics think. Let me give you an example. In a meeting of a Midwestern tire company where I had developed an agreement to create production line forecast for car lines, I was scheduled to present the results, so I had one of our senior economists fly in for the meeting. The meeting went something like this. The CEO reviewed the data, looked up and said to me, now I'm going to paraphrase here because I can't use the colorful language he did, "These numbers make no sense." Well, hearing this, the economist looked back undaunted and said to the CEO, "I never said the numbers would be right, but the models were elegant." What? Well, welcome to the world of academics. It doesn't always matter what is, only what should be. And by the way, I'm not down on academics. I'm not down on all of them at all. But part of my hopes in creating the financial literacy program is to tell you what you need to know from the streets, not from the ivory tower. Anyway, in 1991, together with two very bright colleagues, I formed Chicago Investment Analytics. We went to the world of institutional investment managers with new ideas in how to pick stocks, how to sell stocks, and how to predict certain future events. We were successful by virtually every measure of a small business. We had a good revenue model, a good cost model, and a good overall business plan and a truly great partnership. In fact, I like to think that we were part of the overall movement by the investment management world into quantitative finance. Well, we were so successful that in the year 2000, we were acquired by the Charles Schwab Company, and what a wonderful company that is. Chuck Schwab built a company based on helping investors execute their ideas in the marketplace, not incenting them to invest in his company's ideas. Our work fits so well with their mission, and it's been a real pleasure to see how successful that acquisition has been. Subsequent to that, I invested in all sorts of private equity and venture capital. Some worked as they were supposed to, a couple didn't, and yes, that's painful, but what lessons we learned from failure. By the way, you know how people talk about failure being the better teacher? Well, there's some truth to that, but you know what? I've certainly enjoyed the lessons taught by success much more. It's more fun. Well, anyway, on to my story and why I wanted to do this so badly. In 2005, at the age of 43, I entered a long and protracted divorce process. Now, folks, I know that many of you have suffered through these nuclear wars, and that is exactly what they are. But as a person in their midlife, when it all came down and concluded, and after the attorneys had gotten all that they could, I did some serious soul searching about what my life would be about. I had a number of options. I could go back to Wall Street and work to make as much money as possible. I could simply retire. Or I could try to do something bigger, much bigger, in fact. I could actually try to help people. Not help by providing the type of short-term emotional motivational stuff, but I mean really help people. Not provide the empty promises of politicians, but I mean really help. If you will, to take self-help to the next level of real help. Now, I'll tell you, to many around me, this was a pie-in-the-sky dream that was just too big and therefore would never materialize. Many people thought, Steve, you can't change the world. Well, you know what? I say to them, nonsense. What's needed to change this world is simply knowledge. Knowledge given to empower people so they can make their own choices without the misrepresentations that so often occur on Wall Street, in Washington, and on Madison Avenue. A knowledge not born out of an academic desire to understand how things should be, but born out of the real-world streets where things just are. To me, the question became, why is it that we live in the wealthiest time, in the wealthiest country in the history of mankind, and yet over 90% of the people retire without the money they need to live as they want? Why, after spending trillions of dollars on social programs following Lyndon Johnson's proclamation that we should never have poverty in our country, and therefore his creation of the Great Society programs, why do we still have poverty? And why is poverty seemingly worse than ever before? Why do Americans struggle and stress over finances so much? Why? Well, folks, I believe the answer truly and simply is knowledge. We are inundated with Wall Street, Madison Avenue, and Washington proclamations of how we should live, how we should spend our money, our time, and our talents. And those paths have led us only to the financial turmoil we're in. We need a new model, a new paradigm, if you will, and that's overusing that phrase, but it's true. We need a truly new system of individual empowerment where people have the knowledge, the understanding, and the wherewithal to make their own choices, independent of the manipulations of the power structure. Knowledge is power. You want to help the institutionalized poor in our country? All the programs in the world won't help if they don't have knowledge. You know as well as I do that politicians exploit circumstances for their own purposes. I mean, how many times do we hear from politicians who decry the poverty in our nation and around the world, but whose only solution is another program? Well, we need to truly empower people with the life skills they need to better themselves, and that empowerment is what the Steve Beeman Group is all about. So I had the background, the knowledge, and the deeply held desire to create an enterprise that at its core truly was out to provide real help for real people. As I looked at this, I went into my own experiences and I thought about the 5 paths of life that I was on. Clearly, I had a financial path and I was well established on it. But I also had an emotional path, a physical path, an intellectual path, and a spiritual path. So I set out to build the Steve Beeman Group. And to that end, I've assembled a group of people who share my vision, and together we're embarking on a lifelong journey to provide whatever help we can to all who will listen. This Path to Prosperity program has been a real labor of love to build. While my experiences led me to an understanding of most of it, I've had to do my research too. I've had to interview other professionals to gain their insights, and I've had to compile this into something you could understand and use. I'm confident that this library of knowledge will set you on a path to financial freedom.
Ladies and gentlemen, welcome to this, the first CD of this 12-disc set, Volume 1 of The Path to Prosperity. In this first volume, we're going to be covering information some of you may think is so basic, everyone should know it. You know what? We agree. That's why we put this information in here, because the foundations of finance begin with a full and complete understanding of the banking business. So let's join Steve as he begins our path to prosperity with this important basic disc, banking.
From the earliest days of my working life, I remember having had some relationship with some bank somewhere. I think my first experience, like many of you, was just opening a passbook savings account where I could put in the small amounts of money I earned from my minimum wage job and then watch it as it grew, slowly. Very slowly. Well, as my income grew, this experience grew into a checking account and then a regular savings account and so on and so forth. I never really thought about it much. The bank was just a convenient place to keep my cash, and I never had that much of it to begin with. I never thought about the charges I incurred or the promises my bank made to pay me the highest rate on CDs or charge me the lowest rates on a home mortgage. I just never thought about it. But as I grew and I became more and more aware of banking and all that entailed, I became more sensitive to certain facts. Fact number 1, the bank needs you more than you need the bank. Fact number 2, frequently when you don't need money, the bank will loan it to you. When you do need it, they won't. And fact number 3, banking is a complete commodity, and you should strive to spend as little on it as possible. Today, my friends, there are over 8,000 federally chartered banks in the United States and over 6,000 federally chartered credit unions. These banks and credit unions compete mightily for your business, offering you free safe deposit boxes, better interest rates than the next guy, and lower fees than the next guy, whatever they can do to differentiate a fundamentally similar business. So what are these mighty institutions that so impressively put up large stone buildings and seek to impose an image of power and stability? What do they do, and how do they do it? And more importantly, how does this all affect you? What does it matter? Well, at the core, a bank is a very simple place. It borrows money from you, the public, through the deposits that are made. And yes, that means that every time you make a deposit of your payroll check or anything else, you're loaning the bank money. The bank takes that loan from consumers in the form of checking accounts, savings accounts, and certificates of deposit. That's the inflow side of their business. The outflow side is the loan that's made using your borrowed money. Banks loan money via credit cards, home loans, car loans, and business loans. That's about it. They borrow money from you and loan it out to your neighbors. Pretty simple, right? Well, it is. But let's take just a few minutes and go a little deeper into what they do to provide you the necessary information that you need to take charge of your relationship. On the deposit side, the three principal vehicles banks use to collect assets are checking accounts, savings accounts, and certificates of deposit. Fundamentally, they're all the same. You're loaning money to the bank. The difference is in the time frame of the loan. When you deposit your money into a checking account, those funds should be available to you immediately for withdrawal. So the bank doesn't get much use of your checking account money, and therefore they don't pay you much for it. In fact, increasingly banks are charging you for checking accounts because there's just no money in it for them. Now, in some circumstances, you'll find that banks even hold the funds, meaning that you can't access them right away. Now, you can't really blame the banks for this. There's a practice known as check kiting, in which someone deposits a check that's no good into one bank, and then they withdraw the funds only to cover the bad check with another bad check from another bank. This can be very profitable. In fact, so profitable that in the 1980s, the E.F. Hutton Company, a very large Wall Street investment bank, was convicted of bilking the banks out of millions of dollars by writing these bad checks. Now, of course, individuals do that too. As a result, some banks will hold deposited checks until they've cleared the other bank. This ensures that there are good funds to cover the deposited check. Again, you can't really blame the bank, but it is frustrating as you, the honest consumer, lose immediate access to your money. Remember that the bank is simply holding your checking account money with the expectation that you will write a check, that is, withdraw your money, immediately. And by the way, debit cards act just like that as well. Where a check is a paper instrument that's written to give another a claim on your account, a debit card likewise gives the merchant to whom you present it immediate access directly to your account, that is, your money. Thus, checking accounts, which now include debit cards, are the most liquid and readily available form of cash that you've loaned to your bank. Extending the timeframes a bit, and thus reducing the liquidity and availability, is the savings account. Here again, you loan the bank money, but they expect to keep it longer, which gives the bank a longer time frame to use it. Thus, because they have more use of your money, they'll pay more for it. Now, the rate they pay you is set on a number of factors, including the economic environment, in other words, what other interest rates are doing, and how large an account you have. It may or may not be obvious to you, but the larger a savings account is, the more cash a bank has to use, and therefore the more valuable it is. So a $100,000 savings account will be treated preferably to a $500 savings account. They're both loans with direct claims to the cash, but the bank can use the $100,000 more readily than it can use the $500. Today, savings accounts are paying interest at the rate of about 1% per year. That means that if you loan $1,000 to the bank in the form of a savings account, the bank will pay you $10 in interest over the course of the year. Here, like the checking accounts, the banks can't pay you much because they can't be assured that you'll leave the money with them for any long duration. The third form of a loan you can make to the bank is in the form of a certificate of deposit, or CD. This is a time-based loan that can run for 30 days to many years, and you can loan money via a CD for many different denominations. Now here again, the amount the bank will pay you for your loan is contingent on two primary factors: how much you're loaning them and how long you're loaning it for. The more money and the longer time, the more they'll pay you in the form of interest. So the next time you deposit money into your bank or credit union, think of it as it truly is, a loan from you to them. Now, a couple of questions come up that deserve to be answered. First, is your money safe? Well, 100 years ago, the safety of your money was contingent on the size of the vault. Now, though, following the turmoil of the Great Depression, the money you've loaned the bank is guaranteed by the Federal Deposit Insurance Corporation up to $250,000. Now, this guarantee is good for both individuals and businesses who, by the way, are much more likely to keep that kind of cash on hand. In 2008, they raised the limit from $100,000 going through that financial turmoil in order to make people feel more safe about their money. Well, the ultimate backstop for the FDIC is the federal government and the federal taxpayer, where through the U.S. Treasury or the Federal Reserve, the Federal Deposit Insurance Company can access the funds it needs to shore up problem banks. The second question is, why am I charged for checking account services? Well, as we discussed, checking accounts are a cost center for any bank. Because they can't use your money for very long, they can't make money with it. Thus, the cost of the bank building, the tellers, the technology, and all the like have to be paid somehow. Also, as Americans moved short-term money from bank checking accounts to, say, money markets, the banks were left in a position of needing to generate income. Thus, many banks now charge service fees of up to $20 a month on checking accounts. Also, it's not uncommon today to have other fees like ATM withdrawal fees, check fees, and the like. Again, when you think about the bank as borrowing your money, look clearly to have a relationship with a bank that charges you the smallest possible fees. The second side of the banking business is the lending side. This is both just as simple, but also just as complicated. Now, just like the deposit side, the lending side takes several forms. The most common is credit cards. Credit cards are unsecured short-term loans. Most people don't think of it that way, but they're actually signature loans, meaning that they're secured only by your signature. That's very high risk for the lending institution because, of course, there's no collateral. I'm sure most of you know this, but collateral is something you put up to guarantee the loan so that if you don't fulfill the contract, the lender will get the collateral in trade. Well, on a signature loan, like a credit card, there is no collateral. Thus, credit cards carry very high default rates, and as a result, they also carry very high interest rates. Some banks, like First Premier Bank, offer credit cards to high-risk individuals, but then they limit credit to $300 per person, and they also charge monthly fees amounting sometimes to up to $30, which is 10% of the credit line. Well, that offsets the risk of their not getting paid back. The second type of loans that banks make are for secured assets like cars and homes. These collateralized loans carry lower interest rates than signature loans, and the reason is simple. It's because they're collateralized and the bank can repossess the asset if the loan isn't repaid. They're not fully secure, though. Let's be honest. Cars depreciate, so if the bank loans you $20,000 to buy a $20,000 car, immediately after you buy it, the car's only worth $15,000, but the bank and you are still on the hook. So they're not fully collateralized. And for a better example, let's look at today's housing prices. Over the last decade, the banks, thirsty to make loans and also trying to accommodate federal housing laws, were loaning up to 100% of a home's value. Then, As we've seen recently, the values of the home shrank by 30 to 50%. Well, in many circumstances, homeowners walked away and the banks were left with assets worth sometimes 50% of their loan values. So even collateralized loans aren't without risk. The third type of loan made is the business loan. This takes many forms like the consumer loan, ranging from unsecured lines of credit to secured lines of credits, fixed mortgages on factories and fixed mortgages on equipment. Without these lines of credit to purchase inventories, make payrolls and the like, business would almost immediately fail. In fact, that was the genesis of the great financial meltdown of 2008. The banks stopped lending money because they became afraid they wouldn't get paid back. It's that simple. But it's also that profound. If the banks don't lend money to you because they're afraid they'll lose it, the economy will grind to a total stop, which then snowballs down to disaster. So there you go. That's a brief but concise overview of commercial banking. But there is more. There is, for example, another form of institution that you should be aware of, the credit union. Think of a credit union as a bank that's owned by the depositors and therefore operated not for profit, where a commercial bank is owned by shareholders and operated for profit. Thus, the fees charged by credit unions are oftentimes less than the fees charged by commercial banks. The services, however, are just the same. So consider a credit union as an alternative to a traditional bank. As we continue now in our important foundational study of the world of banking, I want to move into the notion of our central bank, the Federal Reserve. There's a lot of history behind this, and I don't want to get too deep into that. But suffice it to say, the Federal Reserve is a privately owned bank created by the government in the early part of the 20th century. It has the specific purpose of smoothing out the U.S. economy from the cycle of boom and bust that had been in place for the prior 100 years. Now, we could argue all day as to whether or not the Fed has actually done that. I mean, look at the Great Depression. Look at the horrific inflation of the 1970s, or the recent close to meltdown we had in the economy. But regardless of whether they've done it or not, their purpose is to stabilize the economy by controlling our money supply. Quite simply, they print the money you and I use every day. I mean, look at the bill in your wallet. It says plainly Federal Reserve Note. Keep in mind, the Federal Reserve is a private corporation. It's not the government. So your faith in the value of those Federal Reserve notes is faith in a private company, not the government. Now, in reality, that private company can print whatever amount of money it wants, so it can't run out of money. But it can significantly affect you by increasing or decreasing the value of the money you earn and use every day. It does this through several vehicles, but the bottom line is this. The Federal Reserve can increase the money in our society by buying government bonds or reduce the amount that banks have to keep on reserve. That's part of what's known as fractional reserve banking. For example, in a period like we're in right now, where the economy is on the brink of a slowdown, if we're not in one, the Federal Reserve will prime the pump by adding money to the system. So today, the Fed is buying U.S. government bonds and lending money to the banks at 0% interest. This cheap money program is providing certainly gas to the economy, but it also leads to the risk of inflation. Inflation simply is defined as too many dollars chasing too few goods. Okay, let me put that in English. That means if we have a total money supply of, let's say, $1 trillion, and if you have $1 bill that will buy you a hamburger, if we then double the total money supply to, say, $2 trillion, your dollar is only worth half of what it once was. So that hamburger now costs you $2. That's one form of inflation. The actual money supply in the United States as of 2010 is a little over $10 trillion. This supply of money has expanded greatly over the last 2 years, which is why some economists now warn of impending inflation. Now, the Federal Reserve, as I mentioned, is a private institution, and it's owned by member banks. Now, ownership of the Fed is a little different than normal stock ownership. The member banks who own shares are paid by the Fed for their capital contributions. But let's remember, the Fed is nonprofit, so there's no distribution of profits. But even with that, I'm quite sure that both you and I would like very much to be part of this highly exclusive group of shareholders. The big argument against the Federal Reserve is that it holds a great deal of unelected power over you and me, the private citizen. This power stems from the Fed's power over the money supply, and thus its control over our economy. If the economy is too slow, the Fed increases the money supply to get it going again. If the economy is too fast, then the Fed decreases the money supply to slow it down. But what if the geniuses at the top of the Fed are wrong? What if they become politically controlled and print too much money to stimulate the economy, and that then leads to a devaluation of your money through inflation? What if the Federal Reserve just prints up money for its friends in the banking business and it bails them out of their bad decisions? In some ways, this just happened, of course, as our Federal Reserve gave trillions of your dollars to foreign banks in support of them through this financial crisis. But who voted for that? Who gave them the right to give your money to foreign bankers? Oh, but wait a minute. Whose money is it? It's the Fed's money. Remember the phrase Federal Reserve note? The money is the Fed's. So they can print as much of it as they want, and they can use it however they want, as long as the U.S. Congress lets them operate in secrecy and autonomy. Now, I'm not given to conspiracy theories, and I do believe the Federal Reserve, managed through its Board of Governors, generally strives to achieve what is known as price stability. In other words, prices that aren't swinging wildly up or down. I do believe, though, that the Federal Reserve is managed by people, and those people are fallible. Yes, many of the people involved have doctorates and even Nobel Prizes to their names. But let's not forget that it was Nobel laureates who gave us the disaster of long-term capital in the 1990s, or those same academic geniuses who gave us the recent mortgage meltdown. As I've said before, sometimes academics just don't understand the real world in which you and I live. Sometimes, but not always, academics see things as they should be, not as they are. The third piece of the banking puzzle is the investment bank. Unlike commercial banks, investment banks typically don't take deposits, or at least they haven't in the recent past. Now, I'm sorry for the history lesson, but it's necessary. One of the causes of the Great Depression was the lack of separation between commercial banks, that is, deposit-taking institutions, and investment banks, that is, institutions working in securities underwriting and sales. Thus, as the bankers took in deposits, they were free to risk them in the world of stocks and bonds. This proved to be a disaster as it put the banks at risk of collapse. Now, I'm going to digress a minute because I'll be darned if history doesn't repeat itself. The causes behind many of the bank failures in the 1930s were, and get this, identical to the causes in the 2000s. Have we learned anything? I guess not. Well, anyway, as a result of the financial disaster that hit the country, during the 1930s, a law was passed that separated commercial banks from investment banks. What it said basically is that deposit-taking institutions could not also act as underwriters and sales agents for stocks and bonds. This act was known as Glass-Steagall, and it greatly reduced the risk to the banks. But it also kept them from engaging in one very profitable side of the financial business. Now, if we look at investment banks, they in fact do have glamorous titles and glamorous job descriptions, but at the core, they serve two functions. First, they help raise capital for businesses and government by underwriting the sale of stock and bond offerings. And second, they engage in actively trading these securities back and forth, which creates a liquid secondary market. Now, there's consulting they do and other things as well, but those two first things are at the core. The underwriting business can be truly glamorous and certainly profitable. Let's say, for example, the United States is going to war. Well, take World War I, for example. And let's say it doesn't have the money to do that. Well, it approaches an investment bank and pays them to sell bonds to the public, and that in turn will help pay for the war effort. If you study this function of the investment banks, you'll see that selling war bonds is as old as history itself. Every government has done it, and every government will do it. When the government spends more than it brings in other words, when it runs a deficit, it pays the investment bankers to sell its debt to others, thus providing the government with the cash it needs to operate. The same is true for businesses. If a company wants to expand, let's say they need $500 million for that expansion, and they don't have the money, they pay an investment banker to raise the money for them, either through the sale of a bond, which is debt, or a stock, which is equity. The numbers here get huge, which is why you see such big salaries paid on Wall Street. If, let's say, an investment bank raises $1 billion and it takes a fee of, say, 3%, well, the fee paid is $30 million. That's a big fee. And the driver behind receiving that fee is the person who had the contacts to win them the business and therefore do the fundraising. So that individual person is paid a very big chunk of that firm's $30 million fee. Now, when the economies are in transition, the investment bankers make huge amounts of money. For example, as the U.S. was growing in the 1800s and the railroads were being built, enormous amounts of capital were required, and it was the investment banks that provided it. In the 20th century, not only did the industrial growth of auto and steel and energy industries require significant capital, but the governments around the world fought 2 world wars and countless other small wars. In addition, they created social programs that, when taken together with military spending, ran huge deficits that needed funding. So the investment banks have cleaned up in the recent past, as it were. Now, the second function of investment banks is to create a secondary market. They do this through the network of registered representatives they employ, otherwise known as stockbrokers. These brokers act as selling agents, and they sell either the initial public offering, that is the first time a company or government security is offered, or they sell securities in the aftermarket, in the secondary market. So when you go to a broker to buy or sell a stock, you're banking on there being someone else on the other side of that transaction. If you're selling, someone else better be buying. And if you're buying, someone better be selling. Well, the brokerage side of the investment banks conducts this trading through institutions like the New York Stock Exchange, the American Stock Exchange, the NASDAQ, and other exchanges. The creation and promotion of this secondary market for stocks and bonds helps create liquidity, which then increases the interest of the investing public. Let's put it this way. If ABC Company wants to raise $10 million and their investment banker approaches you to buy some of the stock, you probably wouldn't do it unless you could turn around and sell it when you wanted. Well, that's correct, right? Well, a strong secondary market in the United States and in other developed nations creates an active marketplace for those shares so that you can take the risk of buying the initial public offering, knowing that you'll be able to get out of those shares in an active secondary market. So there you have it, a concise yet complete explanation of the world of banking. We've learned that there are 3 driving parts to the banking industry: the commercial bank and credit union, the Federal Reserve or central bank, and the investment bank. Working together, these institutions create liquidity and help raise the capital that fuels the economy of the United States and of the world. It's an effective system, but it does sometimes break. We saw that during the 1920s, when the Federal Reserve was offering money too cheaply. The commercial banks were operating as investment banks and they were offering too much debt. In fact, in the 1920s, if you wanted to buy a share of stock, you only needed to put 10% down. That's known as leverage, and quite high leverage at that. Think about it. You bought a share of stock at $20 by putting only $2 down. If that stock drops by, let's say, 20%, which is very common, it's now only worth $16, and you're underwater by $2. Well, now you have to come up with the money or your position will be sold and you'll be on the hook for the balance. Well, this incredible leverage was part of the cause of the Great Depression. Now, I'm curious, do you see a similarity here between the meltdown in 1929 and the meltdown in 2008? Sometimes it's shocking how closely history mimics the past. After the collapse of the Great Depression, the investment banks were separated from the commercial banks. We talked about that a few minutes ago. Well, interestingly, in the 1990s, the separation of these two institutions was repealed so that investment banks could take deposits and commercial banks could underwrite securities. In my opinion, this was no small part of the financial collapse of the banks in 2008. Deposit-taking banks like Citibank and investment banks like Goldman Sachs had leveraged themselves to such points they couldn't support the debt. Well, that put the deposit-taking banks at risk because they were playing in the investment world. Don't ask me why this was done. I have read and reread the reasons, and all I come up with is that the commercial banks felt left out of the boom of the 1990s, and the investment banks wanted the gold mine that was consumer deposits. Well, anyway, when they got back together, it was like acid and water, and it exploded. Your takeaway from this, I hope, is an understanding that, generally speaking, banking is a commodity for you and me. A nonprofit credit union will offer the same services as a commercial bank, but at a reduced cost. With either, you're safe up to $250,000 in the bank. And finally, watch your credit card providers to make sure you get reasonable fees.
There you have it, a quick, concise, and thorough foundational understanding of banking, of commercial banks, of investment banks, and even of our central bank. I, for one, enjoyed hearing about credit unions, as I've never considered those before. Perhaps now I will. Also, I don't know about you, but I didn't know the Federal Reserve was a private company. Now that's an interesting piece of information.